Does your wealth building journey feel like an absolute grind with no end in sight? But here's the truth. There is a reason why your net worth skyrockets after 100k. I'm going to be taking my decade of experience in finance, including as an investment analyst, and break down why things get easier after 100k and give you a clear roadmap to get there fast. We're also going to cover a truth that so few people will tell you about your first 100k. This is billionaire investor Charlie Munger, the esteemed business partner of Warren Buffett, who is largely considered to be the greatest investor in history. He left behind a legacy of timeless wisdom and fantastic quotes. And included in that rich library of investing and life wisdom is this quote about the importance of the first 100k. Your first 100k is the toughest to earn, but most crucial for building wealth. I don't care what you have to do. If it means walking everywhere and not eating anything that wasn't purchased with a coupon, find a way to get your hands on $100,000. But this leaves us with, two questions. Why the 100k threshold matters, and why is it the hardest to do? So let's get into it. Let's start with an example to really illustrate this. If you invest $1,000 every month with a 10% average annual return, it will take you 6.2 years to go from rock bottom 0 to 100k. Now you might be thinking why we've picked a 10% return as an example. Well, simply because it's the average return of the S&P 500 or the top 500 companies in the US pretty much every year since inception, but it is the average rate. But what happens as we move further up the ladder in $100,000 intervals? The 100k to 200k will only take you 4 years, so that's 2.2 years less than it took you to get from 0 to 100. And that's going to be the recurring theme here, really, that each of these $100,000 intervals is only going to get shorter. But let's carry on working through it. To get from 200k to 300k only takes 2.8 years. And again, an even shorter time interval. Then 300k to 400k takes you 2.2 years. 400k to 500k takes you 1.8 years. You could start to see where this is going, really. But let's fast forward here. By the time you get to the $100,000 interval between 900k to $1 million, you can do all that in bang on a year. And that answers a critical question. Why the 900k to $1 million is 6 times faster than the 0 to 100. So how does this work? And now we've gone through why 100k is so important, I think we really need to go through how this happens, because understanding this will really let you take advantage of it. These same two principles are the same reasons that overpaying on your mortgage can pay outsized dividends, even just with small marginal changes over time. So the first is compound interest. So what is compound interest? Well, the easiest way to think about compound interest is it's the interest accumulated from your original investment amount plus all the previous interest payments. That also means it generally includes reinvesting interest payments as you receive them that would otherwise be paid out. But more on that second half later. So what this means for you as an investor is that you're not only earning money on your original money, but you're also earning money on the interest that you've already accumulated. So when we look at the numbers like we've just done, we basically found that each successive $100,000 increment gets shorter and shorter and shorter. And what that looks like graphically is the gradient of the graph getting steeper and steeper over time. And just to illustrate this, let's expand the pot size to see how this graph getting steeper and steeper over time will impact that. We'll come back to the graph later on in the video to discuss the secret that I mentioned at the start. And the truth is, that's why hitting your first 100k is so highly lauded. Because if you can get to that point, that's when compound interest can really start stretching its legs and going out to work for you. But we should also point something out here, that a marginal increase in the amount that you can invest every month will have an outsized effect on shortening that time horizon even more. So if we take our original example of $1,000 a month, you'd hit $1 million in about 23 years. But if you could increase that to $1,100 per month, then you'd get there 11 months earlier, nearly a full year shaved off to get to the $1 million dash. So I want to revisit this bit here, which we discussed a second ago, because this point is often not that well discussed. For the most part, we've discussed the capital appreciation of your investments using the S&P 500 as an example. Now, that is an important part, but it's not the only part. The other half of this equation is the dividend income, which also benefits from compound interest, but also has the advantage of letting you accumulate more shares faster because the shares that you own are deriving you an income. And look here at this study from Hartford Funds. This really reveals two interesting variables that we have to be considering when it comes to dividends. The first outcome that they find, that dividend income is responsible for about a third of the overall return from the S&P 500. And whilst that might sound important but not critical, take a look at this graph here, which is on page 1 of the report. This shows the S&P 500 returns when you draw down dividends with the grey line just here, compared to the blue, which shows the returns when you include dividends and keep them in the pot to buy more stocks. And this is why it can be so important that when you select a fund, you select an accumulating fund. This will make sure that as your dividends start to get paid out, they get reinvested into the portfolio rather than getting drawn down. So the second thing we should be looking at is scale of capital. This one is more important the further down your wealth building journey you are, but is still important nonetheless. And this is also a simpler concept than compound interest because we're removing the time element, so it's a much more static variable. But if you make 10% returns, as we've talked about so far, for 3 different people, one has $1,000, another has $100,000, and the third one has $1 million. They will take the same amount of risk, they will do the same amount of work, and they will still get a 10% return. But there is no escaping the fact that the first person will only make $100 a year, and the third person will make $100,000 a year. And this is what we're talking about when we say that capital scales. Whilst the final person in our example has more, they don't need to do more to get their 10% return, but they get so much more from it. It can seem like a really trite thing to say, but 10% of a bigger number is still a bigger number. So we've discussed why the 100k threshold is so important and frankly the mathematical mechanisms that you should get there, but we should also discuss why the first 100k is the hardest. So at the start of the video, I mentioned that there was a secret that so few people in these videos tell you. I think when it comes to your first 100k, it really does this whole conversation a disservice. And the truth is that you'll probably not get to your first 100k by investing, but instead by saving. Now that's not to say you shouldn't be investing this money. It's that when you look at the split between the principal amount, which is the money you're actually stumping up into the investment account, and how much of that is compound interest, the amount of work that compound interest is doing is pretty small. That your contributions make up a much bigger part of the total value rather than the interest earned. Take a look here at the split between contributions and interest for the first 100k compared to 900k to $1 million. See the difference in the size of these two bars? That's because compound interest is doing more of the heavy lifting for you because you have more. Another reason why the first 100k is hardest is you're making contributions earlier on in your career where it's going to represent a greater proportion of your take-home pay. Your income will not likely have grown that much, but again, your income will also benefit from compound interest over time. This makes setting aside money and investing it easier every single month because it will represent a smaller outgoing every month for you. But there is also another important and more psychological reason that the first 100k is the hardest. And that's because you likely won't have been through the ups and downs of the market. And trust me, it can feel like a roller coaster at times. By the time you get to your first 100k, at this point, you're probably a hardened investor. You've been through bull and bear markets and you know not to panic and to stay the course. And so lastly, I want to really quickly go through 5 tips to get to 100k faster. And I'm not talking about giving up lattes, avocado on toast, or any of that nonsense that you see in the news all the time. If you want, there are plenty of other channels out there that you can get that from. But we're going to be talking about 5 evidence-based ways to do it. Our first and maybe our most important one is to realize that you need to automate your saving and investing journey. There's this study just here done by Vanguard, which found that automating your investing is one of the most important changes that you have to make. This will turn you from a sporadic saver to a consistent investor. Just set it and forget it. Second is to watch out for fees. We've talked extensively about the power of compound interest and how it's maybe one of the most important tools in the world when it comes to building wealth. But that same power can be used against you when it comes to fees. Let's look at an example. So if I told you I was considering 2 different fund providers, one of them charged an investing fee of 1% and the other charged an investing fee of 2%. So you invest $100 per month from the age of 18 and retiring up at 65. And let's, for argument's sake, stick with our 10% return. The difference in the value of the 2 funds would be $221,631, a truly staggering amount of money. The fund with a 1% fee would be worth $788,402, and the fund with a 2% fee would be worth $566,771. So pay attention to your fees. Third, learn to pay yourself first. Get paid, pay your needs, then pay for your saving and investing, and then use the money you have left to pay for your wants. Most people pay for their wants and hope they have enough at the end of the month to put into savings, but this is a critical mistake. Learn to pay yourself first. Fourth, have a budget. At this point, there is just so much evidence that shows that people who have budgets have better financial outcomes. Like this study just here. This study highlights that stress from poor budgeting correlates with diminished financial wellness and emphasizes the importance of budgeting in achieving financial stability. Having a realistic budget that you can stick to makes all the difference. And if all else fails, the 50-30-20 budget can be a great place to start. And finally, and maybe most importantly, start as early as possible. And I know it can seem easier said than done, but the earlier you start, the more heavy lifting compound interest will do for you and make your life so much easier. If you like this video, then you'll like this one just here, where we give you tips on how to invest like an ISA millionaire, and this video just here where you can watch it and fix your finances in 20 minutes. Thanks very much for watching. If you've liked this video, please like and subscribe.